Right now, I want to talk about the difference between a traditional construction loan and a one-time close construction loan. So my name is Drew Smith. I'm a licensed loan officer. I specialize in VA loans. Now, where I work at Military Home Spot Lending, we can do other loans, USDA, conventional, FHA, but I personally specialize in VA loans. So right off the bat, full transparency, I've done VA one-time close new construction loans. I've never done traditional new construction loans, but I've talked to colleagues that have and other lenders and banks. So I'm going to talk at the high level, the differences, but there could be more subtle nuances which you might have to research further. So the main difference right off the bat is that the one-time close is exactly what it sounds like. You only close on the loan once. VA, OTC, one-time close new construction loan. On the other side, we've got a new construction loan, but it's not a one-time close, so you've got two different loans here. So you've got the construction loan, so you have to go to a lender, you qualify for a construction loan, then the builder gets money, they start building the home throughout that phase. During that process, you're making interest payments. You're making monthly payments, typically interest only, so you're not paying on a principal or anything, you're just making monthly payments while they're building the home. Then once they're done building the home, you have to get a takeover loan, a new loan, which is your mortgage. So whatever you want to do. You want to do a 15, a 20, a 30-year mortgage, it's up to you. You can do whatever type of mortgage that you want, but it has to take over that construction loan. And that's going to be your long-term mortgage. So that's the big difference there. So they've got pros and cons. Let's talk about some of the differences and what the market kind of has done over that time. So I like the VA OTC new construction loan because you get everything locked in and you don't have to have that stress about what you're going to do. It's all kind of taken care of at time of purchase. The application is just like any other loan. You qualify, you get pre-approved, you close on it. They don't start building the home or anything until you've closed and finalized that deal. Then the wholesaler or the lender works with the builder and they start taking draws on that and they build the home. While they're building the home, you don't make any payments on it or anything like that. Then once the home is done and they turn it over to you, that's when your mortgage starts and that's when you start making those payments, but everything's locked in. What we saw here, or some of the benefits of your traditional construction loan could be if you're in an interest rate environment where rates are going down, you don't want to lock in your interest rate now because you think interest rates might be getting better in the future. So they're building that home, could take 6 months, could take a year, however long the home takes to get built. Interest rates are going down, so you haven't locked in your interest rate, so you could be getting a better interest rate by the time you closed. That's great. However, we just came out of an environment where interest rates have been going up. So what we saw were people were getting priced out of their homes because they weren't being built and completed in time. So while interest rates were going up, their mortgage payment kept creeping up and up and up to the point where they didn't qualify for the takeover loan anymore because their debt to income ratio was so high because interest rates went up so high so fast. So you've got, risks and challenges with both, but that's really the high level. So your traditional construction loan, you got to approve for basically two loans. OTC, it's one loan, all done at the same time. OTC, maybe you won't get the best interest rate, but at least it's locked in so you can feel confident and safer and more secure knowing that that's going to go through, while the other loan, it's a little bit more nuanced. Now, they both have costs to them, right? So on the construction loan, you're going to be paying those interest payments while they are building the home. On the OTC or new construction loans, there's admin fees that they build into the loan. So they both have different costs to them. Really, to get the best, information or comparison, you would have to talk to two different lenders that do them. I've done the VA OTC. Borrowers that I've worked with are very happy with those products. I know other people, friends, family members, colleagues that have done the traditional, and they've been happy with those as well. So they've got pros and cons. It really just comes down to you and what you're comfortable with and what lenders are willing to help you with. There might be different qualifications for those. On our VA OTCs, we've got a minimum credit score requirement and a max DTI limit on those. So, with the traditional new construction, there might be similar requirements with those as well. So hopefully that helps, but at the very minimum, at the high level, that should at least give you the main differences between the two products. For more mortgage tips and tricks, please feel free to like and subscribe. My name is Drew. I'll see you in the next one.